Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us live from the MarketSite studio in Times Square, New York City, we have Chris Sugden, managing partner at Edison Partners, to discuss why entrepreneurs and management teams have a whole new mindset they have to adjust to when it comes to raising capital. Chris, it is great to see you. I think you were one of my last guests at MarketSite before we had to shut down for COVID, and the world is such a different place right now. The paradigm has shifted when it comes to growth equity. What are some of the trends that you're seeing there?
It's great memory, March 6th, 2019. It's crazy to be back. Thanks for having me back. Lots of things. I think we were just talking about, one of the big things is entrepreneurs, management teams, boards, all in this mindset of growth at all costs, up and to the right, up and to the right. Mm-hmm. And you know, you're here now, a paradigm shift overnight. And you're in boards now trying to get management teams to realize value is going to be, your company's going to be valued differently going forward.
This valuation reset, though, did have to happen. It
had to happen. Oh, things were insane. Right. And you don't find yourself in growth equity, you know, really finding value stocks. There's still a premium on great assets. But the point is, it got crazy. And revenue multiples north of 20 times becoming the norm, just out of control. So I think in some ways, yeah, this is healthy. In other ways, it's pretty scary for companies that are in that position where they raised money at a ridiculous premium, and now their cap table's kind of stuck, right? No one wants a down round. So what do? Do you start structuring the next round? Do you put a little more structure to get an up round? Do you have a flat round? So any companies that were in this mode of we're going to raise this year, we have to raise this year, it's a very difficult conversation. You know, to talk our own book, I think we feel good about generally when we're funding, the next round's more offensive than defensive, if you will. So if you're in a defensive mindset, where you had to fund losses, you're really stressing right now.
So when you're looking to put capital to work, what kinds of companies are you looking for? What are you looking for within these entrepreneurs and management teams that will make sense for deployment?
I think what you looked at it before, but now it's even more important. Can a CEO explain the unit economics of the business at the basic level? Does he or she have a CFO that can go at the deeper level? And that got forgotten for a while. You had a situation where unit economics was forgotten if I could accumulate. It wasn't quite .com on eyeballs, but it got to a point where metrics were more vanity metrics than real business metrics. So I think the first thing we look at is, from a unit economic perspective, we're in the growth equity space that's, if you will, in the mid-cap growth equity. So these $10 to $30 million revenue companies that frankly haven't raised a lot of capital anyway. So generally speaking, they haven't gotten their position where the cap table's already a bit of a mess when we come in because of this valuation reset we just talked about. I think what we're looking for, so we do fintech, healthcare IT, and enterprise software. A lot of marketplaces and enterprise software, which are capital intensive to begin with. And who's figured out a marketplace without being overly capital intensive is one of the things we're looking at in that space. And fintech, as you know, which I've been doing for literally 20 years, it's been tough, really tough across the board. However, I still think we're really early days in fintech. And then the other thing we're looking at, healthcare IT and fintech is starting to converge a lot more. The healthcare businesses, whether it's the payer, insurance companies, or the providers, are acting much more like businesses than they used to. And a lot of the same problems that fintech faced 10 and 15 years ago are happening right now in the healthcare space. So a lot of our fintech experience applies, whether it's payments, whether it's revenue cycle management. Relative to some of the things we just talked about, creator economy, Web3, crypto, we're spending a lot of time, have spent a lot of time for the last few years. I'm still bullish in the early days here of that space. Where we play is more kind of back office, regulatory. There's a lot of building left to do in that space, as we know. And we've seen it, some of it with some of the problems here and the collateral that's gone bad and these companies that are having trouble. I think there's a lot to be done on the good old fashioned basic plumbing around crypto. And from a Web3 creator economy perspective, that's been under fire because you had a lot of bad habits. You had a lot of companies being overvalued without a real revenue model. Now you're gonna have a little bit of, we gotta have a business first and then raise money second.
And that leads me to the next question when we think about how much experience matters, because these are newer technologies with younger founders, and while they might have great ideas, if you don't have the operational experience behind you, or if you don't have someone who's advising you that can think through the lens of, it's not my company, I'm here to advise, that's really critical.
You know, the gray hair is earned, I guess. Back in 19, it wasn't as much. You know, this is my third cycle. I was a startup CFO in the .com boom and bust. At Edison here, 21 years. So we've sort of been there and done that. Most of my team's tenures are 10 plus years. The good news is we around the table at Edison have seen this movie before. Great companies are built right now, because frankly, we said this earlier too, in our pre-talk, public stocks are cheap. Theoretically, private stocks will be cheap. We're still in a little bit of a cycle where it's not fully reset. But the point is, these founders don't really understand, you raise money at the price you can, not the price you wish you could.
Right.
And that's still a mindset shift that's going on, just like the grow at all costs. You don't have everybody shifted. And to your point, it's nothing against age, it's just they haven't seen this cycle.
Right.
They haven't lived it. And we had our annual meeting last month, and I sort of said, if you're a founder who's anywhere less than 35 years old, what did you do before you saw nothing but an up and to the right economy, right? In every way. Capital was easy, capital was cheap. It was all, frankly, the only thing that was hard was, frankly, hiring, right? And now we'll start to see that become a little easier, so building your company become a little easier. But so around that board table, you sort of see that look, maybe you're right, but I need to hear it again and again and again. And so what I've frankly seen in our portfolio with some of our younger founders, it takes a second and third round of conversation. It takes them seeing their pipeline extend. It takes them seeing some ripples. Because frankly, as we know, we're in this really weird cycle. The economy, we talk lots of recession talk, but there's a lot of good things going on. If you look at all the data in the private markets, we're still dealing with last year's data, right? You haven't really seen Q1, Q2, and now as we're into Q3, what that's going to look like. So the entrepreneurs are still seeing pretty healthy valuations from deals that were baked 3 and 6 months ago, right? So you still have this bit of cognitive dissonance because of the time it takes to get private market data out there.
Right.
So I think the point there is a little bit of ripple in the water of uncertainty. Now you can kind of dig in and go, okay, let's rev the plan. Get in and get down and dirty.
Yeah, it almost seemed like even the term unicorn became ubiquitous with all. I mean,
everyone.
What did we bring? Oh, I think in Nasdaq alone we brought nearly 800 companies public in 2021, and just to see the valuation reset is really quite stunning.
And this is the interesting thing when we have private equity firms, sort of, if you will, above us in the ecosystem, the $100 to $200 million check writers that were sort of minting a unicorn a week, and they come in and look at our business, they love it. Now they're trying to figure out, can we figure out a valuation, right? It's not so much we like the business, it's what should we be paying? Because if you look at all the public comps in many ways, in fintech especially, they're disconnected from what the companies are really worth because it's just been such a beaten up marketplace. So we're a little bit in this private market premium. We saw that back in the GFC as well. The market right now, I think, is giving a premium for private companies because everyone knows the publics are too beaten up, which is kind of interesting. The question is it 6x, is it 8x, is it 10x revenue, or is it 10 or 12 or 15 times EBITDA? Those are the kind of conversations. The good news is we're done with 20 and 50 and 100x revenue because that was
on projected revenue 5, 6, 7 years out.
Right, if they ever have it.
Right.
Exactly.
So, well, it's interesting to see how this is going to play out. Appreciate the insight as always, Chris. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.